All
All
right.
right.
2 more questions.
Okay. The next one. What is a safe strategy to invest with leverage apart from a mortgage?
Mm, it's kind of like it's inherently risky. So it's kind of difficult to call any leverage strategy safe. Like by levering something up, you're kind of definitionally making it riskier. Although there is that one paper from Ayers and Nalabuff that say that borrowing when you're young actually makes long-term outcomes safer. So maybe I shouldn't say so unequivocally that leverage is risky, but that's a bit of a different use case maybe, or a different way to frame risk at least. Uh, I think for a retail investor who really wants to use leverage, products with a built-in leverage take a lot of the operational load away. They can have drawbacks, like they're going to be more expensive, for example. And I'm not by any means recommending them. We don't use leverage products at PWL either. But as Robert Merton said when he was on this podcast, complex financial strategies like options, which you can use for leverage, are best delivered to retail investors in the form of a product rather than telling them to go and buy call options themselves. As an example, there's inherent risk in a leverage strategy, but there's also risk in executing that strategy properly. And if you go and read like the Wall Street Bets subreddit, there are lots of people who have done pretty serious uh, damage to their personal finances by by using options inappropriately. Now, I'm not saying that the person asking this question is going to go and use options in that way, but I do think that there is execution risk for someone who is not a sophisticated investor in using options, just full stop. So I do like we've talked about this, I think, in past AMA episodes, that some of the newer financial products that do return stacking, which again, as we've talked about, I'm not crazy about the general concept, but I think if somebody really did want to use leverage to have exposure to multiple asset classes in a portfolio, those products are a really neat way to do that. Um, yeah, but I mean, I don't know if the listener was hoping that we would go through like, well, you could use options, you could use a home equity line of credit, you could use an unsecured loan. I don't know all the different forms of leverage and what's the optimal one. I think it's going to depend on your situation and what exactly you're trying to accomplish. But for many of the use cases of leverage, I do think that productizing it is a pretty useful way for retail investors to access leverage if they want to do that, which I'm not recommending and we don't do. But if that's what you wanted to do, I think that's a pretty good way to do it.
Yeah, my thoughts on this are that I don't really think there's any safe strategy to invest with leverage. Although it's interesting that the questioner said apart from a mortgage. I would say there's really nothing apart from a mortgage, because the mortgage is the one leverage strategy that's pretty easy to defend, right? I mean, there's a bunch of reasons for that. If you mortgage your principal residence, first of all, you're getting enormous utility from the asset that you're buying, which isn't the case if you borrow to buy a portfolio of stocks. There isn't a whole lot of alternative, right? In other words, if you want to buy a house, most people can't buy part of a house and then add a little bit more every week or month like you can with a portfolio of stocks, right? So it's either you don't buy it or you buy it with leverage. And then I think the final thing is houses can certainly go up and down in value, but not to anywhere close the level of volatility as a stock portfolio. And what blows up the execution of a leverage strategy is an inability to deal with the volatility of the asset that you've purchased, right? So if your house will go up and down in value, but not in the same way that a volatile portfolio of stocks can do. Now, whenever you buy an asset that is not particularly volatile, your expected return on that asset should be relatively low. So borrowing at 3% and buying an asset that you expect to return 10% is probably overly optimistic. But borrowing to buy a home that you can comfortably make the payoffs and live in during that period, and as we said before, no one panic sells houses, right? When they fall in value, people do what they should do with stocks, which is, I don't care what the value is except on the day I need to sell it. So for all those reasons, I think leverage becomes quite important or quite productive. in terms of a principal residence, but I can't think of any other investment situation that comes anywhere close to that.
Yeah, I mean, in theory, someone might argue that it makes sense to add a bunch of assets together that make the overall portfolio less risky, and then lever that up to the risk of, say, the volatility level of a stock portfolio. And that's a safer way to invest than using stocks. And that's again something that I wouldn't necessarily do in the name of simplicity, and also that it's not super obvious that that's actually going to lead to a better outcome. It's one of those things where there's lots of really interesting things that we can model and say, look, this might have worked in the past, but the portfolio of gold, long-term bonds, stocks, and I don't know what else goes in there, something else. And with leverage, I don't know, not a great strategy, in my opinion. But it may be great for someone else, which is fine. All right, last question from Kushla. What is your view on the potential impact of demographic changes and what is trendy in investment for those who buy and hold ETFs over the long haul, 20 plus years? They're super trending now for a good reason, but what happens when the current wave of investors wants to cash out in retirement if trends or demographics have changed and there are fewer buyers? Even if the underlying asset prices are good, could the sell price of the ETF suffer? Is there any research or modeling on this possibility, and what is your view? On the last part of the question, it's fairly rare for there to be kind of dislocations between the net asset value of an ETF and its unit price. They can happen. Dave Nadig, who's got a lot of expertise in ETFs, told us way back in an older episode that he considers that to be an additional pricing vector for the underlying assets. So if you have illiquid assets in an ETF and the ETF price, unit price changes when the NAV doesn't, he's saying the ETF price, because it's more liquid, is probably a better indication than the actual value of the underlying assets. So he's arguing that's not really a dislocation. I think Marco Semin disagreed with that when he was on. He's done research on that too. Anyway, it's fairly rare for there to be big differences in the unit price and the net asset value of an ETF because of the arbitrage mechanism that's designed to keep those things pretty close. Okay, now on the main question, I think it's important to remember the money doesn't leave the system. When someone sells, someone else is buying. That has to be true. It's possible that the changing characteristics of asset owners can affect asset prices, and that is discussed in some of Ralph Coyne's work on the shift away from active and toward passive management. Assets shifting from investors with higher demand elasticities, like actively managed funds and hedge funds, to investors with lower demand elasticities, like index funds, does seem to have an effect on asset prices. And he does look at that in the paper, Which Investors Matter for Equity Valuations and Expected Returns. To test the effects of the shift to index funds, he holds demand, him and his co-author hold demand elasticities for different types of investors constant, and then they compute the counterfactual asset prices in a world where the shift toward indexing had not happened. It was kind of interesting to think about. He did talk about this on his episode, his Roush Reminder episode, if people want to hear more. So to the listener's question, how do changing demographics change asset prices? I don't know if we can know that. Like if assets are shifting from one demographic group to another, are they going to have different demand elasticities in such a way that changes cross-sectional asset prices? Maybe, but not in a way that I think is either predictable or scary, necessarily. Now, index funds do seem to have made markets less elastic. Do you have a comment, Dan?
No, I thought it was funny that you mentioned it. It's not either scary. What did you say? Either predictable or not particularly scary. Yeah, I think it's true. Like there's a lot of these trends that, yes, they might very well turn out to be true, but should we be worrying about them? And even if we're worried about them, what are we going to do about them?
Yeah, I mean, it could be scary if you want it to be, but I just mean like it's not something that we should dwell on and think about. Oh no, this thing is going to be really bad. Now, a kind of related point is that index funds do seem to have made markets less elastic. Index funds have inelastic demand for stocks. Their demand for stocks is completely insensitive to stock prices. They buy what is in the index without considering whether it's cheap or expensive. So imagine going to the grocery store and planning to buy 5 apples. If apples are usually $1, when you go to Costco or whatever. But today I mostly shop at Costco. Well, we actually have there's a delivery service out of Montreal that delivers fresh produce. So we've started getting a lot of our produce from there. They deliver to where we live, which I was actually really surprised by. But I still go to Costco every week. Big fan. Lufa is the Montreal delivery service. They've been fantastic. It's a lot of like locally grown produce from around Montreal. Anyway, so if apples are usually $1, but today they're $5, you might buy fewer apples or maybe no apples, like I would. If apples 5x in price, I'm probably not going to buy apples that week. Maybe I'll buy grapes instead. I don't know. But that's because in that example, your demand for apples is elastic. Now, if I had inelastic demand, if my job was to buy 5 apples, regardless of what their price was, I'm going to buy 5 apples. And that's kind of what index funds are doing. They have inelastic demand. They buy regardless of the price. Um, and so it's possible that as index investing becomes more prevalent, the market could become increasingly inelastic. And then what that means is that a transaction like investing $1 in the stock market in an inelastic market increases the market's value by more than the $1. So there's like Ralph Coin has an estimate that puts that figure at $5. And the same thing is true for individual stocks. And we had Valentin Haddad on this podcast a while ago, and he talked about his research on that. Now, inelastic demand for stocks can lead to more volatile prices and more price impact from trading. In a perfectly competitive stock market, increasing the weight of index investors would not matter because their inelastic demand would be offset by active managers increasing their demand elasticity as they kind of compete with each other to bring information to the market. And that's kind of the classical view of how markets work and why the shift to index funds doesn't really matter. But the problem is that competition among active managers may not be as fierce as that simple model kind of suggests. And that's what Valentin's paper looks at, is how competitive is the stock market paper. And so he finds that while active investors do increase their demand elasticities to offset the effect of a shift to indexing, the response only reduces the effect by about 2/3. Anyway, so he basically documents that prices have become less elastic over time as indexing has increased, which can increase volatility at the stock level, and increasingly so when a stock has more passive investors. Does that mean that if people are like, en masse liquidating their retirement accounts to fund their spending, that we're going to see a massive decline in stock prices? I don't know if it's that obvious to draw that conclusion, but it's something to think about. If markets are getting less elastic over time, maybe flows start to matter more, and maybe changing characteristics of investor bases start to matter more. And this is kind of Mike Green's whole point, although he's a little more extreme on the expected impacts of it than I think I would be. But I think the general direction of his thinking is probably right. Vanguard does have a paper on this topic, but not on the price elasticity piece, which would probably drive Mike Green nuts. The fact that Vanguard has looked at this and haven't looked at that specific piece, because he kind of blames Vanguard for a lot of the stuff that he's worried about. So their paper is titled Megatrends, the Economics of a Graying World. They explain that lower fertility rates and longer life expectancies are expected to drive unprecedented shifts. That's a quote. This is all a quote, actually. In the composition of populations globally, as the percentage of those aged 65 and older is estimated to nearly double. This is an older paper, from 8% in 2015 to 15% in 2045. And they say that demographics are only one factor affecting economic growth, but these changes do have important implications for how economies may evolve. So they estimate that these demographic trends will have a neutral to negative impact on long-term GDP growth. And their idea there is that lower population growth and lower participation in the labor force are going to have one effect, but that may be offset by higher productivity growth that is needed for a shrinking number of workers to support a growing number of retirees. And they conclude that from an investor's perspective, although demographics may exert downward pressure on the risk-free interest rate, risk premia are not clearly linked to demographic changes, which makes sense. And so Vanguard concludes that in light of these conclusions, a low-cost, globally diversified portfolio provides the best chance of investment success through exposure to a variety of growth and demographic outlooks. which is sounds like something that we'd say.
Well, I was going to say, isn't it funny how that's the cadence of virtually every answer here, right? It's like, yes, this is true. Yes, this is interesting research. At the end of the day, your best chance of success is a low cost, globally diversified portfolio of index funds, period. And it's not to dismiss the importance of the question, right? I don't mean to come across that way. But there are a lot of things, a lot of trends that will affect investment performance in the long term. But at the end of the day, we don't truly understand how that's going to shake down. And even if we did, I don't know what the alternative is, right? How do you respond? Like if you knew that was going to be true, that there would be more selling pressure as the population gets older, there's going to be more sellers than buyers, et cetera. I don't know how you react to that.
And
I don't know how
you
you
know what?
reposition your investment strategy in order to capitalize on that or to make that risk go away.
Well, that's when we've had Mike Green on this podcast, when I've talked to him, that's one of the most striking takeaways that I got. And maybe that's my own lens of listening to Mike, is that, yeah, these things might be a big issue. Yes, it's very possible prices are becoming less elastic. Yes, it's very possible that could lead to big price declines in the event that there was a shift in in dollars from one set of asset owners to another, or a shift in overall asset allocations that people want to have, which can put increasingly large downward pressure on prices if prices are less elastic. We can say all that's true, but what should you actually do? Like, okay, Mike, I hear what you're saying. That all makes a lot of sense. Like, what are we going to do about it? All you can do is stay invested and like hope that it's mitigated by the time that it becomes a problem, if it is a problem, or hope that it doesn't happen in your lifetime. But there's not a whole lot that you can do to fight against it. And Mike also acknowledges when we talk to him, even if we agree that all those things are issues that will eventually come to a head, we have no idea when that's going to happen.
Yeah. No, it's a little bit like health concerns, right? Like there's a lot of parts of our health that we can control, and there's a lot of parts of our health that we can't control. And if we spend too much time worrying about the grave consequences of health issues that we can't control, I don't know that we're any further ahead, right? We certainly have more anxiety. Maybe we have lower quality of life now, but we haven't really done anything to protect ourselves. So we're glad that there are other people out there researching these things, because it's not like they should be ignored. But at the level of the individual investor, you got to focus on what you can control. And this doesn't seem to me like something you have any control over at all.
No, I think people have a bias for action. They'll think about this big thing is scary, therefore I should do something. And that something can take so many different forms. And in many cases, that form is some of the stuff that we talked about during this episode. Like, I'm going to buy these structured notes to protect my downside because I'm worried about the aging population crashing the stock market. I think that's one of the biggest challenges investors have, which speaks to one of the other questions that we had in this AMA about the boring middle and staying in your seat and not getting distracted.
Mm-hmm. People don't like uncertainty, and they will do anything they can to try to get a little more certainty. And sometimes those decisions end up meaning you pay more for a product that you think will deliver, certainty, but either doesn't, or it does at too high of a price. Or we just spend too much time with with the anxiety that, doesn't have any long-term benefits, unfortunately. So